Silver didn't just move, it snapped. In a market that normally inches, it lurched hard enough that the people who run the plumbing reached for the emergency brake. The CME didn't respond with commentary or reassurance. It responded with collateral. 1% for heightened risk. That is the system saying, in numbers, that volatility has crossed from inconvenience into clearinghouse risk. And this didn't unfold over months, not weeks. In 48 hours, silver went from ordinary noise to a posture of containment. For years, the story has been that modern markets are too liquid, too electronic, too well cleared for old-fashioned squeezes or settlement stress. Yet, when the tape began behaving like a crowded exit, the response wasn't to praise liquidity. It was to demand more cash, immediately, from anyone using leverage. That's always the tell. Margin hikes during stress don't just reflect risk, they create it. They force liquidation, they turn a move into a cascade, and they arrive when institutions are already positioned, not by guessing, but by watching flows. Vault data spreads, and the gap between what the screen says and what the real world is paying. Information asymmetry isn't a rumor, it's a design feature of markets where the plumbing speaks before the headlines do. What follows isn't opinion, it's pattern. It's the sequence that appears every time silver tries to do something silver is not supposed to do. Price behaves oddly, rules tighten, paper liquidity looks fine, physical signals start charging a toll. The new data looks worse than last time because the contradictions are sharper, the system has less patience for leverage, and the physical market is sending signals that do not match the calm story implied by paper liquidity. Welcome to Signal and Substance, where we decode what matters before it becomes tomorrow's headline. If you value analysis that sticks to structure and incentives, consider subscribing the way you'd keep a wise elder in your orbit. Not for hype, but for clarity. And drop a comment with where you're watching from, because silver tells a different story in different places. And those differences are part of the signal. Now, let's reconstruct what actually happened, the way a risk desk would, by following the mechanics. In the final stretch of January 2026, silver hit a volatility wall. Futures pricing became a battleground between those who needed exposure and those who needed out. Volatility accelerated, spreads widened, and the market began to feel less like a smooth auction and more like a series of abrupt air pockets. When that happens, clearing systems care less about narratives and more about settlement. So margins rose, and brokers often tightened further at the account level, which is how a funding problem becomes a price problem. Under normal conditions, margin is the cost of admission. Under stress, margin is a lever that reshapes price. It removes the marginal participant. It compresses the field. It is designed to protect the clearinghouse, but it also changes the market's balance of power by narrowing who can stay in the game. When margins jump, every leveraged holder faces the same message: bring more cash now or reduce the position now. If enough participants cannot bring the cash, the selling becomes mechanical, not thoughtful. This is where the central mystery begins, because the public narrative says silver is liquid and plentiful. Paper liquidity looks enormous. Contracts trade all day. ETFs trade with tight spreads. Price discovery appears continuous. But during the same window, physical signals were pointing in the opposite direction. Tightness, premiums, and regional dislocations. A market can look full on paper and still be constrained in metal, and silver is the classic instrument where that contradiction can persist long enough to trap people who assume one layer tells the whole truth. Here is the abnormality. If silver were simply falling because demand was weak, collateral requirements would not be jumping in the middle of the move. Geographic premiums would not be widening. Inventory narratives would not be tightening. Falling prices on soft demand usually come with easing stress. This episode combined volatility, tighter rules, and stubborn physical signals. That combination is not a normal commodity sell-off. It is a structure under strain, and when structure strains, the consequences are rarely gentle. To see the structure, you have to zoom out and look at the hidden pattern, because silver's biggest moves rarely start with the price. They start with the plumbing. In 2011, silver ran hard, pulled in momentum, and then risk controls came down like a ceiling. Margin hikes arrived in rapid succession, and the price didn't just cool, it broke. The point is not the exact top. The point is the mechanism. Leverage piles in, collateral requirements tighten, and forced exits amplify the reversal. The market resets, and confidence rebuilds slowly, leaving behind a memory that lingers in every subsequent rally. In 2020, the shock was different. Supply chains seized, refineries slowed, logistics fractured. The paper price could print anything, but the physical market told a different story through premiums, delays, and a scramble for specific forms of metal. The result was a split personality. The screen price said one thing, the real-world price said another. Eventually, the gap narrowed, but it narrowed through volatility, not through calm, because the constraint was real, and the paper market had to reprice around it. In 2021, public attention tried to turn that physical narrative into a squeeze story. The focus was a week of headlines, but the deeper structure was the same. Paper can absorb a lot of excitement until the physical market starts charging a premium for certainty. When certainty gets expensive, the market is already telling you something fundamental about constraint, even if the screen price is still being pushed around by leverage. Now, in 2026, the pattern returns with a tighter coil. Rule changes are happening quickly, physical premiums are flashing, inventory narratives are tightening, and the debates are louder because different experts are measuring different layers of the system and calling them the whole story. The first parallel is the timing of rule changes. Risk controls do not tighten when everything is stable. They tighten when something is moving too fast, when participation is too leveraged, or when settlement risk is rising. A margin hike is the market operator saying, without drama, that tail risk is rising and the clearinghouse wants less exposure to it. That may sound boring, but boring is exactly what the system is trying to restore. The second parallel is dislocation. In normal times, regional differences exist, but they do not explode. When you see unusually large premiums between major hubs, it signals scarcity, friction, or urgency. It signals that the marginal physical buyer is willing to pay more to secure metal, not paper exposure and not promises. And because silver is both an industrial input and a financial asset, that urgency can come from very different places at the same time. The third parallel is institutional posture. Institutions do not announce, they reweight, hedge, shift collateral, and use vehicles that convert flows into metal holdings. That is not coordination in a shadowy sense. It is coordination in an incentive sense. Their job is to manage risk first and narrative second. By the time the story becomes obvious, the positioning is usually already done, and what is left is the public trying to interpret the consequences. So who are the players this time? Start with the exchange and clearing infrastructure. The CME is not a commentator, it is a risk manager. Its primary goal is settlement. When it raises margins, it is responding to volatility and perceived risk. Brokers often add their own house margins on top, which means the real funding burden can rise more than the headline numbers suggest. That is how a market goes from manageable to unholdable quickly, especially when the move is already forcing daily variation margin calls. Then there are the major ETF and trust structures, especially those designed to hold physical silver. One of the most watched vehicles, SLV, has reported holdings above 526 million ounces in early February 2026. That matters because it represents a channel through which demand can translate into metal held in vaults, reducing float. It also matters because it becomes a focal point for narratives about where the metal went, and whether flows reflect real demand or internal rearrangement. Either way, it is a visible ledger of how much metal is being warehoused by financial structure rather than left circulating in the open market. Next is the futures delivery ecosystem. Warehouse and vault figures become proxies for availability, but they also create confusion. Not every ounce reported is equally deliverable. Categories can shift without new metal arriving. And the difference between metal that is eligible and metal that is actually offered is the difference between a statistic and a supply. Still, when inventories trend lower and when reports highlight declines on the order of 20+% over a few months, the market receives a simple message. The buffer is thinner than it used to be. Then come the physical hubs. London remains a center for wholesale pricing and OTC flows. Shanghai and broader Chinese demand reflect both industrial pull and retail appetite inside a manufacturing engine. Reports that China has been paying a roughly 14% premium relative to London are not trivia. They are a flare that the marginal physical buyer is living in a different reality than the marginal paper trader. When that spread widens, it is telling you that the cost of certainty is rising in the place where industrial demand is most relentless. Finally, there are the institutions that shape the market through positioning and hedging: bullion banks, trading houses, industrial consumers, and macro funds. Their exact positions are not always visible in real time, but their behavior leaks through timing. When collateral tightens, when spreads behave oddly, and when volatility clusters, it often means large players are adjusting risk and the market is repricing around them. The tape becomes a footprint of decisions that were made quietly, then expressed loudly. The story is that two realities can coexist, and they cannot coexist forever. On one side is the paper market, which can create exposure almost endlessly. Futures, swaps, and other instruments allow hedging and speculation without metal moving an inch. That is why the paper market can look liquid, even when the physical supply chain is constrained. It is why the screen price can fall even when physical premiums rise, because the screen reflects a marginal paper flows, not the last bar sitting in a vault. Paper sets the headline. Physical sets the constraint. On the other side is the physical market, which has limits that do not care about chart patterns. Refining capacity, transportation, fabrication, and actual inventory impose constraints. When those constraints tighten, you see it in premiums, delays, and regional spreads. You see it when one hub has metal, but moving it is costly or slow. You see it when industrial buyers quietly lock in supply rather than gamble on spot availability. In those moments, the physical market is not negotiating with opinion. It is negotiating with necessity. The dislocation becomes the gap between exposure and possession. Exposure can be created. Possession must be sourced. And when the gap widens, the market has to close it somehow. In late January into early February 2026, the tension between those realities sharpened. Reports pointed to China paying a double-digit premium relative to London. Inventory narratives pointed to a thinner buffer. 9-to-1, a rough way of describing that paper claims can multiply faster than metal can move. None of these metrics is perfect on its own, but together they describe a market that is not comfortably balanced. And when a market is not comfortably balanced, small shocks can create large moves. Now add the margin hike, and you get a mechanism that can produce extreme moves in both directions. The market can drop because leveraged longs are forced out, then rebound because underlying physical pull does not disappear. That is why these episodes feel like traps to anyone who watches only the price. The price becomes a battlefield between mechanics and fundamentals. And mechanics usually win first because funding is immediate, while supply chains are slow. Let's translate the margin change into plain language. When margins rise from 11% to 15%, the cash required for the same exposure rises by about 36%. 5% is heavier still. This changes who can hold through volatility. It changes the economics of being long or short. And it arrives while variation margin demands are already rising with every sharp daily move. Funding, not belief, starts driving decisions, and the market begins to punish anyone who relied on leverage to stay in the trade. This is why margin hikes can coincide with sharp drops. It is not about villainy, it is about procyclicality. The rule change pushes the weakest hands out at the worst moment. Longs may sell to raise cash, shorts may cover to avoid collateral calls. In both cases, forced flows amplify the move. Price becomes a consequence of funding constraints, and the narrative shifts from fundamentals to survival. At the same time, physical signals do not instantly respond. If the physical market is tight, it stays tight. Premiums do not collapse overnight because futures printed a lower number. Fabricators still need metal. Procurement schedules still exist. Supply chains still have lead times. So you can get the most confusing outcome. The screen price falls while real-world buyers still pay up for certainty. That is the moment when headlines say one thing and receipts say another. That confusion is a feature of silver's structure, and it sets up the next phase, reconciliation. Dislocations like a double-digit premium do not persist indefinitely. They close in one of three ways. Physical tightness eases, and the premium compresses down toward paper price. Paper price rises to meet physical, and the premium compresses upward. Or volatility explodes, and the market whipsaws until both sides are forced into the same reality. Through repricing, rationing, and inventory movement. Historically, when collateral tightens at the same time as physical signals tighten, the violent path becomes more likely because the system is trying to remove leverage while the real-world demand for metal is still present. Now make the mechanism simple without dumbing it down. Think of the paper market like a theater selling tickets. Most nights, the theater sells tickets for seats. Most tickets change hands a few times, and the show goes on. But the ticket market can trade far more tickets than there are seats because most people never show up to claim a chair. They just trade the tickets. That works until a meaningful number of participants decide they want the seat, not the ticket. In silver, the seat is physical metal delivered, fabricated, or secured. The system assumes most participants will roll, offset, or cash settle. It assumes liquidity will handle it. But if physical demand rises, if inventory declines, and if confidence in easy sourcing weakens, then the value of the seat rises relative to the ticket. The premium becomes the price of certainty. It is the market charging extra for the thing that cannot be printed with a keystroke. Margins are like the theater manager raising the entry deposit on a chaotic night. It does not create more seats. It changes who can keep their ticket. It can force speculators out, reducing pressure. But it can also concentrate the remaining demand into stronger hands, and if physical tightness remains, the core tension does not disappear. It just moves to a higher level of intensity. The show continues, but the audience is different, and the ticket price behaves differently too. This is also why experts talk past each other. One analyst looks at futures volume and says the market is deep. Another looks at physical premiums and says the market is tight. Both can be correct because they are measuring different layers. Paper depth does not eliminate physical friction. Physical friction does not prevent paper volatility. The contradiction is the story, and it is why these episodes keep surprising anyone who assumes one metric can explain the whole system. So what does the pattern suggest going forward if the ingredients continue to line up? After margin hikes and forced liquidation, the first phase is usually a clearing. Weak leverage is removed, volatility can subside briefly, commentators declare the story finished. But the second phase depends on whether physical indicators relax or tighten. If premiums persist, inventories remain thin, and large holding vehicles remain large, the market often revisits the stress point, sometimes when the crowd has already moved on to something else. A conservative path is mean reversion without resolution. The paper market calms, price stabilizes, and physical premiums slowly narrow as supply responds and demand normalizes. The headline drama fades, but the structure remains sensitive, like a fault line that has not released its pressure. A moderate path is a volatile climb. After the leverage purge, price rises again as the marginal buyer shifts from leverage speculation to physical hedging and real demand. In that case, the dislocation closes upward, with the screen price doing more work to meet physical reality. The market doesn't move in a straight line. It moves in bursts because funding and inventory do not rebalance smoothly. An aggressive path is renewed stress triggered by another shock, further inventory decline, a surge in physical demand, a logistics disruption, or another wave of collateral tightening. In that case, the market rations through price and volatility, and the story becomes less about what people believe and more about what the supply chain can deliver. The most important point is that constraint is solved by price, and price is discovered through stress. Notice what is missing. There is no guarantee, no certainty. There is only what the mechanism tends to do historically when collateral tightens into volatility while physical signals refuse to loosen. What matters then is what to watch as evidence. Watch margin and collateral policy changes because they reveal how the system perceives risk. Watch inventory trends and the composition of deliverable stocks because totals can hide what is actually accessible. Watch regional premiums between major hubs because they reveal where the marginal physical buyer is paying for certainty. Watch volatility clustering because bursts often mean plumbing is driving price, not just fundamentals. And watch whether the paper narrative and physical reality keep diverging because divergence is what creates the potential for violent reconciliation. Here's an additional clue that often gets ignored. Spreads. When a market is healthy, the relationship between nearby futures months, spot quotes, and physical premia tends to stay in a narrow lane. When stress rises, that lane widens. A small change in financing costs can create a large change in behavior because participants start paying for time, not just price. Watch for sudden shifts in nearby month activity, unusual roll pressure, and sharp changes in the cost of carrying exposure. Watch for days when the paper price falls, yet retail or wholesale premiums refuse to budge. That is the market revealing two prices at once, the price of leverage and the price of metal. When those two prices diverge, headlines get loud, but the more important signal is whether the divergence persists for multiple sessions. Persistence is what forces inventories to move and rules to tighten. That's when the next squeeze narrative stops being a metaphor and becomes math. This brings us to the divide. It is not between optimists and pessimists. It is between people who watch the output and people who watch the process. Price is the output. Plumbing is the process. Institutions operate on collateral, basis, inventory buffers, and timing. Smaller participants often operate on headlines and emotion. That is why institutions tend to move first, and the public tends to react last. The gap is not intelligence, it is sequence. And in markets built on leverage, sequence is everything. If you take one lesson from this episode, take the structure. When the exchange raises margins into volatility while physical premiums flash tightness, the market is negotiating the difference between exposure and possession. That negotiation has never been polite, and it rarely ends quietly. This is signal and substance, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether silver will have another dramatic chapter. The data suggests it often does. The question is whether the mechanism is recognized while it is forming, or only after it has already forced the market to choose.